Welcome to the Leader's Edge podcast. I'm Sandy Laycox, Editor-in-Chief of Leader's Edge. Kicking off a new season of our series with global insurer AXA XL, I'm joined by AXA XL's Bob Peretti, Chief Distribution Officer for the Americas. Chatting on the eve of RIMS, we go in-depth on the property market, including the size of the market, current cost drivers, risk management, and more. Give it a listen. Bob, it is so great to have you here with me again on the podcast. We spoke about 2 years ago or so now, so thank you for joining me again.
Thanks, Sandy. It's great to be speaking with you again. I'm glad to be able to do this.
Yes, we are on the eve of RIMS here, so we are all about to go to the Risk and Insurance conference in Atlanta. And so, of course, we're thinking about risk management as we talk. And one of those areas that is a lot of risk management is coming into play more and more these days is the property market. As everyone has seen, prices being driven up by increased storms, inflation effects. So I'd love to just hear your thoughts on how AXA XL is addressing, in general, these property market issues with clients.
Sure. Well, it is the property insurance, particularly the property catastrophe portion of property insurance is definitely the hot topic right now. That's for sure. I am having a lot of conversations with underwriters and brokers and clients, and yeah, I guess the place to start on this conversation is the dramatic increase in the storm activity, right? That has occurred the last few years. A couple of statistics that really pop out at you are, last year, 2022, there was the insured losses due to natural catastrophe was 125 billion. And when you think about the two preceding years were, 21 and 22, those years were two consecutive years where property catastrophe losses exceeded 100 billion. And what some of us are starting to ask ourselves is 100 billion dollars of insured natural catastrophe loss the new annual standard? We hope not, but if we're basing things off what happened in 2021 and 2022, that's what happened in those 2 years. So hopefully 2023 will be better than that. But once we see something happening two times in a row, you got to wonder, is this the new level of property catastrophe losses? And if it is, it means a very fundamental change to how underwriters, perceive and ultimately price that risk as they're working on specific accounts.
So when you look at property cost, what factors are contributing to such high rates?
So you've got the effects of the storms, which I've just mentioned. You've got I think continued supply chain issues when you get post in a post loss situation. Inflation is having um, I was going to say it's hidden, but it's not so hidden anymore because people are very aware that the cost of repairing facilities that have been damaged and the cost of restoring the revenues, the sales that have been lost due to storms, they're all continuing to increase, right? So, you've got inflationary factors there adding to the cost to repair and restore. And then supply chain is really affecting both the price of the restoration, but also the time that it takes to repair and restore back to pre-loss conditions. So it's kind of a perfect storm of terrible things that are occurring that we have to pay very close attention to as we're underwriting each individual risk. Yeah.
And so you mentioned sort of this giant market, that's grown so much, and you're sort of asking yourself, is this where it's going to stay? Um, how are you working with clients? How are you and partnering with brokers to work with clients in terms of, assessing the current risk that they have at the prices that things are, and sort of helping them manage this?
Sure. Yeah. Well, I would say education is the the key in all of this, and it's educating our brokers and our clients as to what is actually contributing to the cost of their property insurance or any a line of insurance that we might be working with them on, and helping our clients to prepare uh, their their management for what's ahead as far as costs are concerned. And I think that this has always been true, but those conversations have to occur earlier and earlier, right? So we've actually had we're getting quite practiced at this, and we've had a lot of really good renewals, even when we've had to increase prices a lot. And I would say that they've been good because we started those conversations with our clients and our brokers very early on, and we were able to provide a lot of information and letting them know kind of how we were perceiving not just their risks in general, but the risks that are the specific risks that of their specific account. And I think clients appreciate knowing that the price that they're getting, the terms and conditions that they're getting from our underwriters are based on their specific situation, as opposed to a blanket increase of X% across a whole portfolio. We underwrite each account on its own merits, and I think that it just takes time to explain how we're doing that on each individual account.
And are there things that clients can do to lower their risk and potentially be underwritten more favorably? And then, after that, is there a certain part of this that just is kind of out of their hands, and it's living in
Sure.
areas that are more prone to catastrophe and things like that?
Well, I think a lot of it is out of everybody's hands, right? I mean, nobody can control the weather. We would all sort of acknowledge that. Something that is controllable, but has it's a reality, is that there's been a tremendous concentration in values in areas that are prone to storms, right? So, we have to you know, I suppose that's something that could have been controlled, but we have to we have
Yeah,
to
right.
look at those places and those specific locations and acknowledge that there's a lot of value that's been built up over the last several decades and last 50 years. And I think something that people have to remember is that insurance companies have to look at not just their individual exposures on an individual policy by policy basis, but we have to look at the aggregate. We have to look at, like, how much limit, how much property cat have we provided to all our policyholders, and where is that? Where are those policies issued? Right. So, um, I have spent a lot of time this past month visiting with brokers and clients, and they have said, hey, there's a real willingness to pay for, clients will pay pay higher premiums for property cat, you should sell more of it, right, at
Yeah.
higher rates. But that's really not a very good strategy because we're going to find ourselves, and all the other insurers will find themselves in a very bad spot if they sell too much property cat in a specific location, no matter what the price they get for it is, right? Because it'll it'll really come back to haunt us and haunt anybody else who might do that as well. But you ask about, what can clients do to mitigate these rate increases, and I would say that there are many of the same things that that we've been talking to clients about doing for a number of years. And the number one thing I would say would be, strong engineering. And this is where our risk consulting team gets involved. And, you know, uh, when we see that a client has a strong commitment to risk engineering, that means a lot. And it's not just the commitment to it, but the willingness to make changes, or act on recommendations, and to try to harden and make more resilient their properties. So risk engineering is at the very top of that list. And then, we've talked about this in the past too, that there are a lot of new technologies available. And, just, generically speaking, like sensors to detect water leaks, telematics to collect data while people are driving on the road, wearables that help protect, wearable technologies that help protect workers, and help them improve their how they work and how they move materials. This is, I think, one of the more um, positive things that's been occurring in the last few years to help risk managers and our clients, reduce the cost or eliminate, avoid losses and reduce the costs of the losses that do occur. And we're trying to help clients through what we call our ecosystem, where we kind of curate a lot of these technologies, vet them for clients. And more and more of our clients are taking advantage of this offering, that to work with a brand new cutting edge technology for some specific aspect of their risk profile. And that's really where not all the dollars are, but that's where most of the dollars are. When you look at, the dollar, I mean, this example has been true since the beginning of time, I think. When you look at, how much of a premium dollar is attributable to the expenses of an insurance company versus how much of that premium dollar is attributable to the losses that are going to be paid out by the insurance company. It's overwhelmingly, it's 65% of the premium dollar. It goes towards paying losses. So, when we have clients who retain losses. It's and most of our clients retain at least some part of their exposures. Some of our clients retain quite a bit of their own exposure. So they're very motivated to work with our engineers and to investigate the opportunities to control losses, right? So they're not coming to the conversation reluctantly, like, what do I
Mhm.
have to do, or what are you going to make me do? They're really coming to the conversation asking the question, what can I do? What would you recommend we do? And so um, and going back to those initial statistics that I mentioned, really, I don't think there's any way that the insurance industry can absorb these kind of losses that we've experienced on an annual basis. Like if this is going to be the new norm,
Yeah.
you know, I think clients are going to have to, you know, sort of partner with us to absorb a lot of the risks that occur, and they'll many of them already do. But I don't think that the I don't think it's something that can be addressed by premium payment alone. The solution isn't just to convince clients to pay more premium to pay these staggering property natural catastrophe losses that are occurring every year.
Yeah.
So
It's funny. My question to you to follow up was going to be, do you think that there is enough capacity in the marketplace to be able to continue to insure these sort of really high risk areas going forward?
well, I guess you know it becomes a function of math at a certain point, right? Like, the industry has to take in at least the amount of money that it's being asked to pay. I do think that we will see, and also the property catastrophe uh, insurance. It's a finite amount of insurance. It's not an infinite amount of insurance that any insurance company has to offer clients, right? So what we've seen is a lot of the shortening of a lot of lines, the reduction in a lot of limits. So the insurance industry is going to only offer the capacity and the limits that it can financially offer, right? And
Right.
so I think that's why you've seen a lot of reduction in limits being offered, and I do think that this is going to be an interesting year, because if this year is on par with the previous 2 years, I think people are going to be starting to ask the question that you just asked,
Hmm.
and there could be some even more severe consequences in the future.
So one more follow-up question to this. What what role do brokers have in this in terms of education? And you said that you have more and more clients who are coming to you and asking for risk management type solutions for this. And it's clearly a problem that's not going away. So what role does the broker have here to help facilitate that?
Yeah, that's a great question. And, I think there's an enormous role for the brokers to play. I think many of the brokers have, uh, engineering and loss control offerings on their own, which, they offer to their our mutual clients, right? Um, but I also think that brokers uh, need to they need to continue to do what brokers have always done, and that is to, efficiently organize the marketplace on behalf of their client, so that their client can, you know, take full advantage of what the market might be willing to offer them. When it comes to the deployment of services and engineering and loss control, I'm often asked, well, is this a conflict between, brokers and insurers who are offering the same, or potentially offering the same kind of, loss prevention services? And I'm not really too bothered by like who a client will go to obtain the services that will help them reduce their losses, provided that they go to someone, or that they take full advantage of what's available to them. And I think that clients will ultimately decide to go with whatever service or technology that they believe is going to be the most efficient way for them to control their losses and reduce their losses, whether that's through a broker or via insurer, or someone who's neither a broker or insurer, an independent provider of these services, right? I think it's in the industry's best interest to have the best services and the best technologies in front of the client. And it really is in our best interest that happen and that losses are reduced.
All right. So last question for you. We are all on the eve of RIMS, and I would love to hear from you what top 3 issues you're expecting to address with clients at the conference.
Well, we've been talking about one of them,
Yes, for sure.
property, natural catastrophe insurance. But I think the other two that we're going to hear about quite a bit are sort of the whole umbrella of ESG issues, and also climate change specifically, which is obviously related to the property natural catastrophe issue we've been talking about, but also related to some parts of companies' ESG
Hmm.
concerns. So those are the
Yes,
3 topics I think are going to be the big 3 at this year's RIM conference.
I think that you are definitely on the right track with those. Well, Bob, it has been great chatting with you. I've really enjoyed it, and definitely interested to hear what happens at RIMS as you get into some of these conversations and move some of these things forward.
Great, and I'm looking forward to seeing you at RIM, Sandy.
That was Bob Peretti, Chief Distribution Officer for the Americas at AXA XL. Keep an eye out for our next AXA XL podcast coming soon at leadersedge.com, SoundCloud, Spotify, and Apple Podcasts.